Hello, Stock Charts TV users. This is Tyler Wood. I'm a CMT charter holder, and today I am joining you solo for our weekly installment of the GoNoGo show. Let's dive right into what's happening with markets right now from a top-level perspective across the asset classes. Big news this week is that the S&P 500 has re-entered a no-go trend on the daily basis, and we're going to get into some of the price action in just a minute. But that second panel is showing us Treasury bond price action, heavy sell-offs, which of course moves inverse to yields. And we'll talk about some of those macro forces that are putting pressure and headwinds on our risk assets like equities. In the third panel, we have commodities continuing in a go trend on an absolute basis, but weakening to those aqua bars where we're seeing the trend still in an upward direction, but showing some weakness. And then, of course, the lowest panel, we've got a dollar index ETF, UUP, that has strengthened over the last week into strong go trend conditions. So as I mentioned, let's dive into the headline, which is where we're at with the S&P 500. We have recently entered no-go trend territory, but as we were mentioning on the show last week, Alex and I pay close attention to the GoNoGo oscillator. Sometimes we get leading indicators from momentum oscillators that can show us some divergence between what's happening with price action and what we can see in terms of a momentum reading. We moved into negative territory, so enthusiastic selling at the index level for the S&P 500 on heavy volume. Remember, with that GoNoGo oscillator, when we're in this green color, we've got relatively light volume. Heavy relative volume is indicated when that turns to the dark blue. So on heavy volume, crashed back to the zero line, quickly broke through to negative territory, and that preceded this lower move in price action. Again, the overall trend conditions, trend following indicators are by their very nature lagging indicators. We held on to weak go trends for a time, but this week we entered no-go trends yesterday. Today that strengthened from pink to a dark purple, indicating that the weight of the evidence, all of those technical indicators computed in the background, are strengthening to the stronger form no-go trend condition. Again, this is all on a daily basis. And if we just look back to those lows that we saw in March, some of these pullbacks can be sharp, but somewhat short-lived when we're looking at a secular uptrend or a larger term bull market sort of constructive evidence. So right now, no-go, we're at an oversold level of -5. We often see that those momentum oscillators will mean revert, but as we learned in some of those educational videos that Alex and I were recording for you all, with momentum oscillators, if those mean revert within a no-go trend, we would come back to test the zero line. If that no-go trend persists, the zero line acts as a resistance shelf, meaning it will cool off to neutral and then surge back down in the direction of the underlying trend. Just as we saw here in March, we retest that zero line within that no-go trend. If we get rejected at zero back into negative territory on the GoNoGo oscillator, that's just going to give us some further activity to the downside in terms of price action. The good news is that that's at the index level. And we want to talk a little bit about the macro forces at play, but today's episode, we're going to talk about getting under the hood of the index. Remember, it's a market of stocks, and with this recent pullback at the index level, we can still find lots of opportunities under the hood, particularly as the market has been showing strong rotation into new sectors. So let's move on and talk a little bit about the forces that are driving this sell-off in equities, some of the correlations both to interest rates and to the strength in the US dollar. So if we pull our eyes to this chart of the TNX, the 10-year Treasury yield, we had a pretty clearly defined resistance level. Highs in March, highs again in early July. We briefly broke above in August, a bit of a fake out, not a breakout, and dropped below that resistance level. Markets came back again, and we have seen yields rising all week long into new high territory. Just to give us some context on a weekly basis for where we're at, we're back above those October 22 highs. So remember, October lows in the S&P 500 signified what ended up being the ultimate low for last year's bear market activity that coincided with this peak in yields. So we're going to watch to see if we strike up against additional resistance here in the weeks to come. This is recording on midday on Thursday, and so we're seeing yields right near those former highs. And we'll watch to see what happens in the conclusion of the week and where we head next week in terms of interest rates. The other major factor at play causing some headwinds for risk assets broadly and specifically US equities is going to be the strength in the US dollar. I've talked to a lot of analysts and traders this week just about how significant it is for the USD to break above these areas of resistance. So we had, again, highs in March, highs in June, and this week we broke above that resistance area. As we know from polarity, what has been resistance once broken through can become support. So what we're looking at on a longer term basis for the US dollar, we have been stuck in this range throughout 2023. That's given risk assets some room to breathe as the US dollar had been in no-go territory and just really range bound and choppy. Breaking above this resistance area means we've got a lot of room to run back to those 2022 highs. And again, here at GoNoGo Charts, we like to use ETF proxies for dollar index and other securities because it also gives us a sense of volume. This entire year, we've had light volume on the dollar index. We had a max GoNoGo squeeze that did break to the upside, quickly retesting the zero line. This looks to be a second test of both the resistance line in terms of price action, but also finding key support here at zero and remaining in positive territory from a momentum perspective. So right now we're on light volume. We've got a positive GoNoGo oscillator reading of 2. Plenty of room to run to these prior highs in 2022. And that strength in the dollar index, just like strength in yields, is going to cause pressure on our equities index. So let's turn our eye real quick. We can look at lots of different commodities within that commodity index that was outperforming. We've seen strong moves from energy, from natural gas. We've seen diversified baskets of commodities like this ETF DBC outperforming the S&P 500. And on these heat maps, which we authorize for all of our institutional users, the complete GoNoGo chart here on Stock Charts is going to look just like this. But if you have use for these heat maps and relative strength work, feel free to give us a shout, info@gonogocharts.com, and we can talk about enabling those for you as well. But across the commodities infrastructure, we're seeing a lot of leadership relative to the S&P 500. So each of these is the ratio of that commodity to the S&P, to equities broadly. We're also seeing things like lumber, steel, and even cattle and agricultural products that lead to some of these strong moves on a relative basis, still holding their go trend. We had a brief dip into neutrality this week, but now holding the weak go trend against the S&P 500. And across that commodity space is going to be an opportunity in this frictionless environment of ETFs. If equities at the index level are taking a break, there's certainly a benefit to diversifying what's in your portfolio and thinking about relative strength as one of the factors you might want to look at to allocate your capital accordingly. Moving on from the commodities map, we can take a look at global equities to see if there's strong outperformance from elsewhere in the world. And in fact, that's not the case. We do see a slight outperformance from the IBEX on this daily version of a global equity rel map. We're looking at major equity indices around the world, and we've seen China outperforming the US. We've seen Singapore outperforming US markets. Those have all rolled over again. If we switch that to the weekly view, giving us a little different perspective on the relative performance of other equity indices, we can see that Mexico is still leading and has been throughout 2023 a leader against the S&P 500. So from an equity allocation standpoint, US on a daily basis still looking to be about the strongest of the opportunities out there, but certainly diversifying away from our home bias, looking for opportunities further afield can be a great exercise for all investors. Moving on from global equity investing, as I mentioned at the beginning of this episode, we want to get under the hood of the US equity index and take a look at opportunities across the sectors and the industry groups as well. So that pullback at the index level, remember, S&P 500 is a cap-weighted index, and so strong underperformance or no-go trends in some of the largest tech companies that comprise very large portions of the U.S. stock market, very large weightings of the S&P 500, can give us maybe false signals to what is happening with the rest of the market. And what we can see here is on a relative strength basis, we're looking at each of the sector ETFs relative to the S&P 500. So we have information technology, that's the XLK, in a no-go trend to this falling S&P 500. So we're in a no-go trend at the index level. This is underperforming or moving even lower faster than the S&P 500. Same situation for consumer discretionary. When we get to the communications sector, that's actually been an area of outperformance through the rising S&P 500 as well as in this recent pullback territory. We've also seen that rotation to the cyclical sectors of the stock market, namely the XLE, which is our energy sector, XLF, our financials, the industrials and materials had all been outperforming. We've seen materials roll over this week, underperforming a falling S&P 500. But interestingly, a rotation into healthcare, which is part of our defensive sectors, but also the largest by cap weighting of the S&P 500. So healthcare has a lot of opportunity. And what we do at GoNoGo Charts with this top-down perspective, right? We want to get a sense of the macro landscape. We want to see what's happening at the index level. We want to look further afield, comparing indices across the world, as well as diversification across the asset classes. But once we get to this sector realm map, we can dive one level lower, and we can look at the industry groups within the sectors that are outperforming. So the two that I want to highlight today are in energy and in healthcare, where we've seen some strong blue outperformance, strong go trends relative to the S&P 500, and some very interesting charts within. So if we look at the industry groups within the energy sector, we can see that a lot of that outperformance consistently has been coming from oil exploration and production. That's this second panel. And that's where we want to dive into today with a couple of individual ideas for single stock and single securities. But on this relative strength map, what we're looking at are the the 5 industry groups relative to the energy sector as a whole. So when we do our top-down approach, we continue to use that concept of relative strength to find the outperformance of the industry groups within the sectors that are outperforming the index. That's going to give us high probabilities on our side for finding securities that themselves are in absolute go trends, but are also part of an industry group that is rising. As we've heard from John F. Kennedy, a rising tide lifts all ships. And so we can look for opportunities within those industry groups to look for long opportunities. So within the oil exploration and production, we want to highlight Chesapeake Energy Company. That's a large cap exploration and production firm that has been in a very solid go trend, although not highly volatile. We haven't seen strong price gains. We've seen a lot of activity from the GoNoGo oscillator at the zero line. So on this daily basis, we've been really chopping around for Chesapeake Energy. CHK is the ticker. And that's where you see these trend continuation icons over and over and over. It's climbing slightly higher, drifting higher, if you will, as momentum is trying to find some solid support at the zero line and give us actual confirmation of a stronger uptrend. What you see towards the right side of this chart here in July and then again into August, not only did we find a break of this go-no-go squeeze to the upside, telling us that tug of war between buyers and sellers had resolved in favor of the bulls, but also we've moved to heavy relative volume as price has surged higher. So we had a massive move in the GoNoGo oscillator right up to overbought territory. That's where we saw this trend correction icon, held the go trend despite that sharp correction. And then here today, we've taken off again, breaking out of this smaller GoNoGo squeeze to the upside, still on heavy volume. That's what it looks like on the day-to-day perspective. When in doubt, we can always zoom out. And for Chesapeake, what we're seeing is the very beginnings on a weekly basis to a new go trend. And we're seeing strong positive momentum, volume picking up here this week as we enter that go trend on the longer time frame perspective. So still a little room to run. That's a large cap name. We've seen a lot of strong performance from the mid cap names within this exploration and production industry group of the energy sector. So moving on to Matador Resources, we've seen the beginnings of this run again. Moved into a go trend. That's where our eye moves to the GoNoGo oscillator to find those trend continuation opportunities. It's great to see that the overall trend conditions, the weight of the evidence, multiple technical indicators telling us that we've got a directional bias to the upside, but then we look to momentum for confirmation. And again, that's been confirmed over and over and over and over again, finding support at the zero line, giving us these green circle icons that tell us momentum's resurging in the direction of the underlying trend. That's Matador on the daily basis. Again, a mid-cap name, and we've seen a lot of those that are performing well. This is Matador on the weekly basis. So from a longer-term perspective, a lot of stair climbing, and then 2023 we've seen energy pull back sharply, but we are just beginning now in this neutral territory with positive momentum on heavy volume to start to see the constructive signs of a new trend emerging there. So weekly basis, we're still in neutral, but we've seen some very strong conviction and evidence on the daily basis. Moving on to Vaalco Energy. This is going to be a smaller cap name. Again, we're looking at this on a weekly basis. We've seen 2023 be an area of underperformance. Oil itself in that downward sloping range. This chart very reflective of oil markets generally, but we're seeing fresh go trends on the weekly basis for Vaalco Energy, a small cap name in the space. And if we dive into the daily basis, we can see that that action has been sharply to the upside for Vaalco Energy. Here we're looking at the GoNoGo oscillator on heavy volume. We're still at a +1. We do see this trend correction arrow as we pulled back from extreme overbought, 6 on our momentum oscillator, but still holding positive and holding that price action above what were prior resistance areas. So that's Vaalco Energy. Now, the next move that we wanted to look at was within the healthcare space. New go trend relative to the S&P 500. We're seeing XLV, the healthcare sector, outperforming. So if we do the same exercise and we move into the industry groups within healthcare, we're going to see that the outperformance is really quite strictly coming from our pharmaceutical space. So the DJU SPR pharmaceuticals showing us some strong outperformance of the healthcare sector. And within that industry group, we can start to look at not just large cap pharma names like Moderna and Pfizer, but we could look a little further down the cap scale and see some opportunities in the mid cap and small cap. So Belite Bio is a biopharma company, and we've just filled this impressive gap down here in June. We know that getting above this channel was an important move for price action, certainly dabbling and finding a lot of resistance at the top end of that gap. Here today, we are closing above that prior resistance area. If we move that out to a weekly chart, we can see that we've still got some room to run on a weekly basis, still in that weak form no-go, and we'd be watching, if you're a longer term investor, to see this break at the zero line. We're building a go-no-go squeeze. If we see that move to the upside, that's our confirmation that the new trend is beginning. Moving on to another name, an opportunity, Jupiter Wellness, skincare company out of Jupiter, Florida. This is our daily chart. And if you're one of those investors that feels like you see a chart like this and the move is already over, that you've missed it, that the run has already run its course, just step back to a weekly basis. And here we can see that actually this is a very crowded area. What was support in the downtrend, once broken, became resistance. That's that concept of polarity that Alex and I talk about all the time. It was resistance again at the end of 2022 when Jupiter Wellness was trying to start a new go trend, rejected here at this resistance area, and it's been in a strong no-go trend through most of 2023. We have seen the resurgence right back to that area of resistance on a weekly basis. We're in weak form go trends, but we've also got an extreme overbought reading at 6 on heavy volume. And that's the weekly perspective on Jupiter Wellness. What I'd be looking for as an investor is a clear break above this resistance area. If that is broken to the upside, that then becomes support for us, and we can use that to our advantage in terms of risk reward for making our trades. But that's Jupiter Wellness on the daily basis. Moving over to AN2 Therapeutics, another biopharma company, this one out of Menlo Park, California, on the small side for the cap scale, but certainly a company that's been around for a while. We've seen on the daily basis a move to strong go trends, right? We had the initial move, some consolidation, real sideways and range tightening. We've seen the price action tighten in its range of activity, as well as a build of a GoNoGo max squeeze here on the GoNoGo oscillator. Again, what we're doing is visualizing the behavior of traders in the marketplace, and we can see that tug of war play out. As we've talked about in some of our educational videos, those GoNoGo max squeezes can happen either at points of trend continuation or trend reversal. And that's really the methodology that we believe in, is trying to quantify and explain through mathematics and observing the market where we should be in terms of positioning our trades. So we look to the direction of the break. That move to the upside is our signal that the trend is going to continue, not roll over. We did have this one amber neutral reading from our trend indicator, followed quickly by the fresh resurgence of momentum to the upside, trend continuation icon in this go trend. And we have strengthened the last couple days to the upside on AN2 Therapeutics. So we've got a strong go trend on this daily basis. We can look at it on the weekly and see that still in neutral territory. A lot of these are coming through a bottoming process. So when we think about finding new opportunities and this rotation in the market that's taking place, certainly at the index level, we're seeing some of those mega caps pull back. But looking down the cap scale and looking to different sectors of the industry, we can find those that are basing and beginning to take their role in leadership on a relative basis to the S&P 500. So this is the weekly view of the same pharmaceutical company just entering neutral territory. But the key point for me is this GoNoGo max squeeze that's been dragging on for 3 months through the summer. We finally had a resolve to the upside. That's a strong leading indicator of trends to come on the weekly time frame. And in closing today, let's talk a little bit about PepGen. This is also the daily basis. Not all of the charts have already broken into their go trends on an absolute basis. But again, we were looking at healthcare as a sector that is very recently outperforming the S&P 500. We're looking at pharmaceuticals as recently leading the healthcare sector. And so we're going to see a lot of charts like this that are coming through that basing formation or pattern and starting to show us some signs of progress. So we're on a weak no-go trend for PepGen Incorporated, and we're at the zero line for the GoNoGo oscillator. So I'm not going long a stock like this until we see the evidence or the weight of the evidence on our side. So a break above zero on the GoNoGo oscillator shows us positive momentum. And then we would want to see the trend conditions change as well, moving through the cycle, probably through the neutral and into go trends. So that's it here from GoNoGo Charts. Alex is with his family in the UK this week, so you'll be hearing from me next week as well. I appreciate all of you taking the time to tune into this GoNoGo show here on Stock Charts TV. If you're watching this on YouTube, make sure you also check out the GoNoGo Charts channel. Lots of other educational presentations and our educational series, the 6-part series explaining all of these tools and concepts and technical analysis. We'll be issuing episode number 5 on Monday. And we hope you check that out too, right here on Stock Charts. Talk to you soon.